Back to hedge accounting. Now, this is super important, very, very important, but pretty simple, which is awesome. Now, hedges, right? We're hedging our bet. We are trying to do our best to lock in a price to hedge against losses. What is a fair value hedge? This is a concern that some asset is going to lose its value. We are concerned that maybe we carry a bunch of iPhones and we think that, well, obviously a new batch of iPhones is going to come out next year. That's going to significantly reduce the value of our iPhones. Now, maybe you enter into an insurance contract with someone else and the insurance contract says, okay, if the value of the iPhones goes down, you get paid out. And the amount you're paid out is going to cover the decrease in value of the iPhones. All right, what about a cash flow hedge? Warehouse burning down is my best example, or a factory burning down. Let's say you're concerned about your factory burning down because that would cut your cash flow off, right? If your operations get ceased, well, there goes your cash flow. You're not making any more money. Sucks for you. And okay, well, how do you defend against that? You buy an insurance policy that says if your warehouse or if your factory burns down, you get a cash payment. Awesome. Now, is it effective or ineffective? You'll never have to determine if it is. It'll tell you. The questions will. And basically, is it effective? Does it cover the losses? Is it ineffective? Does your bet not cover your losses fully? The effective and ineffective portion of fair value hedges gets reported in net income. And the effective portion of cash flow hedges goes in OCI. Super important to remember there. Just to check in, definitely make sure you memorize the few components that are included in OCI, such as pension adjustments or foreign currency translation adjustments, different items such as those. Super important to remember throughout the test. You can see a question here that lists out dollar amounts of, okay, we have $20,000 effective of fair value hedge. We have $20,000 of cash flow effective as well. So you'd have to classify it. What goes in the income statement? What goes in OCI? Nothing too out of the ordinary, nothing too crazy there, but memorize it, learn it, love it. You'll do well with that. It'll be many more free points in the exam. Fair value hedge, talk about that a little bit more. A derivative designated as a fair value hedge must be specifically identified to the hedged asset, so to the iPhones, a liability, or an unrecognized firm commitment. Meaning it needs to relate to something, right? It needs to refer to your barrels of oil, your iPhones, liability, maybe bonds or the amount of debt someone has, or unrecognized firm commitment. So maybe this is a lawsuit or something, like the result of a lawsuit. And unless otherwise stated, it's expected to be highly effective in offsetting changes. Now, we saw the effective versus ineffective. It'll have to tell you, like I said. So it's expected to be highly effective. But if it's not, then you need to specify. So that's important for the financials because investors will assume that the fair value hedges are effective unless otherwise stated. Lastly, a couple points to know. You might see the term perfect hedge. A perfect hedge results in neither gains or losses. Now, you might be thinking like, that's weird. First off, it probably will never happen. There's nothing that's going to be perfect. And why would you not want gains anyway? Well, again, with the airline company, their goal is to have a perfect hedge. Sure, if they make extra money on it, that's great. But their goal is to just continue with operations. Their goal is not to make money with it. The gain or loss on the derivative instrument exactly offsets the loss on the item or transaction being hedged. So again, you exactly offset the rise in oil prices with the gain you have on the hedge. And you might also see a qualified derivative as a term. So that might be designed to hedge exposure to variability in cash flow associated with an asset liability or forecasted transaction. So this qualified derivative is essentially just saying, okay, if we are concerned that the world market is going to slow down, or maybe the demand for our products is going to go down, that is more specifically going to cover a lapse in business. Maybe Halloween's canceled this year for some reason. So Spirit Halloween has a qualified derivative that would cover the variability in cash flows.